Hello everyone, I'm Carlo Pereras, IASB Technical Staff and a member of the IFRS for SMEs project team. I'm pleased to welcome you to this webcast. This is the first of a series of webcasts supporting the third edition of the IFRS for SMEs Accounting Standard. In this webcast, I will cover first, the background to the IFRS for SMEs Accounting Standard, second, the background to the second comprehensive review of the standard, and third, an overview of the changes introduced in the third edition of the standard. Future webcasts will be more detailed and focus on specific topics or amendments in the standard. So let's start with a quick refresher on the standard. The IFRS for SMEs Accounting Standard is a standalone accounting standard distinct from full IFRS accounting standards. The standard is tailored for entities without public accountability that prepare general-purpose financial statements. The standard is based on full IFRS accounting standards with modifications to reflect the needs of users of SMEs financial statements and reflect cost-benefit considerations for SMEs. Users of SMEs financial statements are primarily existing and potential investors, lenders, and other creditors. So this map shows where the standard is required or permitted. As at August 2024, 85 out of 168 jurisdictions reviewed by the IFRS Foundation required or permitted the use of the standard. The IASB is committed to maintaining the standard through regular reviews to ensure that it remains simple for SMEs to apply while meeting the needs of users of their financial statements. Since it was first issued by the IASB in July 2009, the standard has been updated twice, including this review, and amended once. The first comprehensive review started in 2012. The IASB prioritized having a stable platform for SMEs, and thus the review resulted in limited amendments to the standard. These amendments were issued in May 2015 and were effective on 1 January 2017. In September 2023, the IASB amended the standard to reflect the effect of the Pillar 2 model rules. This amendment was effective from 1 January 2023. Now, the project we're discussing today, the second comprehensive review, started in 2019. This review resulted in the third edition of the standard, which will be effective on 1 January 2027. That brings us to the next topic, the background to the second comprehensive review of the standard. The review began in February 2019 with the development of a Request for Information, or RFI. In January 2020, the IASB published the RFI to seek stakeholders' views on what approach the IASB should take to the review, whether and if so how the standard should be updated to reflect new and amended IFRS accounting standards, and whether any other matters should be included within the scope of the review. The RFI was open for comment for 9 months. The feedback on the RFI informed the IASB's proposals for amendments to the standard, which were set out in an exposure draft published in September 2022. Because of the broad range of proposed amendments, the exposure draft was open for comment for 6 months. The IASB began its technical discussions of the proposals in June 2023 and concluded them in September 2024. During the deliberations, the IASB decided to consider 2 of the more recent amendments to full IFRS accounting standards. 1, supplier finance arrangements, which the IASB considered particularly useful to users of SMEs financial statements. 2, lack of exchangeability, which would assist SMEs in applying the standard. This decision resulted in the addendum exposure draft, which was published in March 2024 with a comment period of 4 months. So following all these consultations and deliberations, the IASB issued the third edition of the standard in February 2025. The IASB received extensive feedback from stakeholders throughout the second comprehensive review. In addition to engaging with stakeholders and analyzing comment letters, the IASB carried out fieldwork on the proposed revisions to Section 23 on revenue, which aimed to align it with IFRS 15, revenue from contracts with customers, and on whether to introduce an expected credit loss model in the standard. Now, just a quick side note, the incurred loss model for impairment of financial assets has been retained in the standard. Throughout the life of the project, the IASB sought feedback from SMEs themselves, users of their financial statements, and national standard setters. The IASB also sought advice from the SME Implementation Group before making decisions. So let's discuss which full IFRS accounting standards were included within the scope of the review. The IASB considered new and amended full IFRS accounting standards, including those that have been issued since the previous edition of the IFRS for SMEs Accounting Standard. The IASB also considered requirements in full IFRS accounting standards issued before the first comprehensive review that did not result in amendments to the standard in 2015. Full IFRS accounting standards that were included within the scope of the review included IFRS 3, Business Combinations, IFRS 15, Revenue from Contracts with Customers, IFRS 9, Financial Instruments, and IFRS 13, Fair Value Measurement, and also the 2018 Conceptual Framework for Financial Reporting. The IASB also considered topics that had been brought to its attention, like cryptocurrencies and recognition of development costs. With such a broad range of topics to consider, the IASB needed a framework to decide whether to make changes to the standard, because not all requirements in full IFRS accounting standards would be suitable for SMEs. The IASB used what it called the alignment approach. The alignment approach uses full IFRS accounting standards as a starting point. In applying the alignment approach, the IASB developed 3 alignment principles. First, is the topic or requirement relevant to SMEs? The relevance to SMEs principle asks the question, would aligning a topic in the standard with full IFRS accounting standards make a difference to the decisions of users of SMEs' financial statements? Second, can the requirements in full IFRS accounting standards be simplified? The IASB applied the simplicity principle to the new or amended requirements in IFRS accounting standards that satisfied the relevance to SMEs principle. The IASB then assessed which simplifications would be appropriate. In making this assessment, the IASB considered the simplifications it applied when it originally developed the standard. For example, if an IFRS accounting standard allowed a choice between accounting policies, the IASB only added the simpler option in the standard. The IASB also drafted the requirements in the standard using simpler language where possible. Third, do the outcomes, including any simplifications considered, faithfully represent the economics of the transaction or event? This principle considers faithfully representing the transaction or event in words and numbers. The IASB also carefully considered whether the benefits of these changes for users would outweigh the cost for SMEs. After applying the alignment approach and considering cost and benefits, the IASB is satisfied that the 3rd edition of the standard would remain simple for SMEs to apply and useful to users of SMEs' financial statements. So I have now reached the last part of this webcast. Let's talk about the main changes to the standard. Please note that I'm only outlining a few of the big changes to the standard. The IASB has made other changes. To provide an understanding of all the changes, the IASB has included a table of amendments listed by section at the beginning of the 3rd edition of the standard. First, the IASB has completely revised Section 2, Concepts and Pervasive Principles. This new section will help SMEs to develop their accounting policies for areas in which the standard does not specify requirements. Section 2 is part of the standard and therefore holds equal authority with all other sections. However, to resolve any potential inconsistency between Section 2 and other sections, the IASB has added a principle that the requirements in other sections of the standard take precedence over those in Section 2. Section 9, Consolidated and Separate Financial Statements, introduces a single basis for assessing control, replacing the 2 previous models for assessing whether an entity is a subsidiary. The single model will improve comparability between consolidated financial statements prepared in accordance with the standard. The IASB also made some changes to Section 11, Basic Financial Instruments, which is now renamed Financial Instruments because it combines the previous Sections 11 and 12 other financial instruments issues. Other changes to Section 11 include adding a principle that supplements the classification and measurement requirements for financial instruments, adding a definition of a financial guarantee contract, and amending the requirements for intergroup financial guarantee contracts issued for nil consideration. adding new requirements for requiring SMEs to disclose an analysis of the age of financial assets and a maturity analysis for financial liabilities, which will provide users with improved information about the SME's liquidity risk and cash flows, and removing the option to apply the recognition and measurement requirements in IAS 39 Financial Instruments Recognition and Measurement. Next is Section 12, Fair Value Measurement, a new section that brings together the requirements on fair value measurement. Combining the requirements make them more accessible for SMEs, and the amendments will improve the clarity and consistency of the information provided by SMEs that use fair value. The IASB has also revised Section 19, Business Combinations and Goodwill, by updating the definition of a business and introducing the acquisition method of accounting. These improvements will provide users with a better understanding of the cost of a business combination. The last section I wish to highlight is Section 23, Revenue, now renamed Revenue from Contracts with Customers. The IASB has revised this section to align it with IFRS 15, but with simplifications. SMEs will apply a single comprehensive framework in determining when to recognize revenue and how much revenue to recognize. The third edition of the standard is effective on 1 January 2027. SMEs may choose to apply the standard earlier. SMEs are required to apply the new and amended requirements retrospectively in accordance with Section 10, Accounting Policies, Estimates, and Errors. However, some relief from retrospective application is available for SMEs. Future webcasts will cover these reliefs, so watch out for them. So what resources are available to support the third edition of the standard? The IASB technical staff will be updating the educational modules, prioritizing the sections with the most significant changes. Each of the 35 sections of the standard has a corresponding educational module. All are available on the IFRS Foundation website. These modules are designed to provide support to anyone learning about or applying the standard. This webcast is the first in a series that the IASB will publish over the next 12 months or so. As I said earlier, future webcasts will be more detailed and focus on specific topics or amendments in the standard. The IASB also publishes a quarterly newsletter and a podcast series dedicated to the standard. The podcast series informs stakeholders about important updates, shares insights into those updates, and provides information on where to find the related resources. Finally, you can submit implementation questions on the standard at any time. A link to submit questions can be accessed from the supporting implementation page for the standard on the IFRS Foundation website. And that ends this webcast. If you want to stay informed about the IFRS for SMEs Accounting Standard, please refer to our website or follow us on our social media channels. Thank you very much for watching and listening.